This is the Friday, January 16th, 2015 version of the Market Plus segment. Joining us now is Ted Seifried. Ted, welcome back.
Thanks, Mike.
Now, on the show, I had to cut you off when we were talking hog market. You weren't painting a very pretty picture as we wrapped up the program. Can you expand on that a little bit? You mentioned a growing herd size, a lack of PED. What other factors could confound this market going forward?
Well, yeah, the big thing is lower competitive prices for protein. You look at beef prices, you look at the cattle market coming down, and thereby ideally or theoretically producing lower beef prices. It's an uphill battle for pork to really climb that hill. For pork to try to gain consumers, pull them away from beef, it doesn't seem to be happening even at higher prices in beef. So to do it when beef prices or cattle prices are coming down makes it even harder.
Now, is there a typical or historical ratio between pork and beef prices?
For the most part, I mean, we're pretty comfortable with seeing something at a 2-to-1 or even a 3-to-1 at some point. So, you know, we are pretty cheap in pork, but it's just, again, with beef demand not wavering at all, hardly at all, at least, on higher prices, it just seems that the American consumer is really going for the beef.
And, you know, I think that was really played out this week as we watched that choice box beef just, I think, climb all week long, or at least it was climbing early in the week.
Yeah, despite the lower cattle prices, which is interesting.
Yeah. So as we switch over to cattle, as we look at that, are we seeing packers have better margins here in this past week or so?
They've improved, you know, and that is a function of the lower market and the higher prices. So they are improving, and they're due because these guys need to see a little bit of relief there. Otherwise, your middleman demand starts to fall. And that's kind of what sparked a little bit of the sell-off in the futures market as well. Or at least what sent the speculators kind of running for the doors, especially in the feeder cattle market. So that improved packer margin is a building block for some higher prices down the road.
Okay. Now, I'd like to take it and jump over to some of our questions here on Facebook and Twitter sent in by our viewers. And we're going to start here with JJ from Oakley, Minnesota. And he's got a question that you touched on during the program when we were discussing wheat, but I'd like you to expand on it a little bit. JJ's curious, are we finally seeing the value of the dollar hurting ag markets, or is this recent downturn all on the USDA report? Can you filter out which is affecting which part?
Well, you can filter out which markets are more affected by the U.S. dollar. And it's been kind of cliche lately for analysts to be talking about the U.S. dollar and how that's negatively affecting grains. And to an extent, you certainly have to agree with that. Specifically for wheat, but to some extent for corn. Soybeans are kind of a different story because with the Chinese currency pegged to ours, and them being, you know, the big buyer that we're always watching, it's much less of a factor. But as far as wheat's concerned, that stronger dollar really causes a problem because wheat is such a global market. There's so many other countries that have wheat to sell. So when our dollar is stronger, it makes it even more difficult for our wheat to get the competitive advantage over other countries. So again, I would say the dollar affects wheat more than really anything else in the grains markets. So yeah, with that stronger dollar, it might mean wheat has more work to do to go and find that demand and find that export business.
And the flip side of that would be we saw the USDA report really have the effect on corn and particularly soybeans this week.
Yeah, that's right.
We didn't get a chance to discuss beans much on the show. What was the biggest shock in the series of reports on Monday that really was detrimental to this bean market?
Well, we saw a yield a little bit higher than expected. We saw acreage unchanged. We saw exports only go up 10 million bushels, and we saw a 4 in front of the carryover number. A lot of people expecting a 3. The fact that that 4 was still there, I think really is what kind of caused that. You also had funds, and this is not just the soybean market, but also the corn market as well, that have been really trying to push this long position uphill for quite some time. And for the fact that this report was not that breakout to the upside, I think it's really causing or helping cause the sort of exodus from the grains markets and moving into other markets. There's other market conditions that are helping that as well, but these funds I think are just getting tired of trading this range and getting tired of not breaking out to the upside and a continuation of the bull market that we started back in October. So they're, you know, in the soybeans, they're almost on the verge of going short now at this point. Corn, they still have a very large long position, but they trimmed a healthy amount of that over the past few days. And that's something to watch closely, what these funds are going to do going forward. Because if they decide that they've been one of the main drivers on the rally, they've been one of the main buyers on the rally, if they decide that they want out of their long positions, that's a lot of downside potential.
Now, you mentioned on the program how important this next week is for the bean market. With these funds thinking of going short, with so much uncertainty in that bean market, how far down could that drop be? If the rains come as predicted in South America, where could beans be at the end of the week?
Yeah, so next week I think could be very volatile. I would not be surprised to see another 60-cent move in either direction next week, depending on whether we get those rains or not.
Okay, that being said, should producers, hedgers take advantage of some short-dated options, or do you just cross your fingers? What's the best way to handle a week like this one?
We're getting into the special sauce here, Mike. Okay.
Yeah.
Something that I was doing quite a lot of this week and that I really liked, and it just comes at very good timing. We've got February options that go off the board on Friday. February is a serial month. They're based off the March futures. So the opportunity there is to go out and get short March futures, or really you can kind of take your pick if you're not too worried about the spreads. You could go out to November beans or Dees corn if you really wanted to, because on a bull move it should come from the front end theoretically. But you can go out and buy these calls that have 4 trade days left, so there's very, very little time value. You can get something that's really not far out of the money. We were looking at 10 cents in corn, 10 to 20 cents in soybeans for really, we're talking 2 cents in corn and 4 to 6 cents in beans. And then establish that short futures position. I think it gives you a great opportunity to go into this week thinking that the rain is going to happen, and maybe take advantage of a 60-cent move to the downside in soybeans and a 20-cent move to the downside in corn, while your risk is really not too bad there either.
Yeah, cost outlay is fairly small, and you're not in a bad position.
Precisely. And again, it's just really good timing on those Feb options expiring on this Friday. So I generally stay away from the weekly options just because the volume is just really not there.
Okay.
But there has been pretty good volume in these Feb serial month options. So I think that's a great opportunity, and that's very much the position that we've been taking all week.
All right. Now, Phil in Ontario, Canada, wants you to gaze into your crystal ball, and he's curious. He says, I can't believe we're going to have another huge bump in soybean acres after the huge bump last year. Yeah. So he's thinking more corn acres in 15. As you look out with this recent drop in bean prices and talk to producers, have you heard planting intentions change at all? Where do you see that?
We've been, you go back to October, when we were at our lows, and specifically when corn was at its lows. There was a lot of talk out there that we were going to see an 85, 86 million acre corn crop. And now we're talking about, we've seen Informa numbers and other private estimates, our numbers, we're all in the 88 to 89 million acre range. So you've already seen, I think, corn buy some acres on this rally off of lows that we've had. It'd be great to see corn up at 90, 91 million acres, or something similar to what we saw this year or better. But the problem with that is the northern states, the North Dakota, the South Dakota, Minnesota issue, where we have really terrible basis because of the competitiveness of rail with Bakken oil. If that pipeline goes through, that'll change that. But until something like that happens and is built, we have a really hard time buying those acres back. We might need to see something north of $5, which with the current market fundamentals, do we really need to buy another 1 million or 2 million acres for corn that bad? And I don't think we do. So we may have bought all the corn acres back that we needed, and anything more might have to come from lower bean prices and not aggressively lower corn prices. Corn's going to follow, but maybe we stay somewhat stabilized, similar to what we saw at the end of this week, to continue to kind of generate those corn acres. But when all is said and done, I do think you see another record bean acreage number, and it's not because beans are so much more profitable than corn. It's simply a function of less input costs. It's simply a function of risk management. You have bankers wanting to push that way because they're wanting to protect their investment, and it makes a lot of sense. However, I'm a big advocate of going against the trend and things like that. I like the idea of planting more corn acres this year if your basis is favorable, because I think you may get rewarded for that in the end when we do get to harvest next year or beyond. So when all is said and done, I think you're going to see something with similar to an 88 plus million bean crop and an 88 plus million corn crop or something pretty close to that. But you're going to see pretty similar planted acreage numbers, I think, for both corn and beans this year.
All right. Well, Ted, I want to thank you for taking the time to join us here this week.
Absolutely my pleasure, Mike. Thanks for having me.
And thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we will continue to get expert analysis right to you. Thanks for watching, and have a great week.